Stochastic indicator is a very popular one, and it's really a moving average system. I think the crossovers, which we'll get to later, when combined with price trend confirmations, can be very effective. But there are other ways in which it can be used. The indicator was developed by George Lane, and the theory behind it is that prices tend to close near the upper end of a trading range during an uptrend. As the trend matures, the tendency for prices to close away from that higher end of the trading range becomes pronounced. In a sense, this is a way of showing a loss of upside momentum at the top. In a downward moving market, the reverse conditions hold true. The stochastic indicator therefore attempts to measure the points in a rising trend at which the closing prices tend to cluster around the lows for the period in question, and vice versa, since these are the conditions which signal trend reversals. The stochastics consist of two indicators. The first can be likened to a short-term moving average and is known as the %K. Its range is bounded on the upside by a reading of 100% and on the downside by one of 0%. Equilibrium, which is not usually drawn, would be at 50%. The %K never moves beyond these limits. Neither does the other line, which is known as the %D. If you get confused with the names, think of K as quick, and D, the slower one, as dawdle. And D is really a moving average of K. If very short parameters are used, the formula returns a very volatile indicator, but longer-term ones offer a relatively smooth trajectory. The popularity of the stochastic indicator can no doubt be explained by the smooth manner in which these longer-term parameters permit it to move from an overbought to an oversold condition, lulling the trader into a feeling that price trends are much more orderly than would appear from the observation of an RSI or an ROC indicator. Longer-term timeframes used on monthly and weekly charts appear to work much better than shorter-term stochastics used on daily futures charts. An overbought indication is given when the %D line crosses the extreme band, but an actual sell alert is not indicated until the %K crosses below it. When the two lines cross, they behave very similarly to a dual moving average system. If you wait for the penetration, you can filter out some of the situations in which you might get trapped into shorting a strongly bullish move or buying an extremely negative one. Many different formats, formulas and variations have been developed for the stochastic, but the basic one involves two parameters, one for the %K and the other for %D. If you use a short-term time frame for %K, the result will be a very volatile series that is continually moving from oversold to overbought. The one in the middle window happens to be a 5-period %K, and you can see that it's continually generating overbought oversold signals. By periods, I'm referring to the time frame you might be working in, hourly, daily, and so forth. The series in the bottom panel is a 30-period %K. It too moves from one extreme to another, but on substantially less occasions. This next chart introduces the %D, so you can see how it operates. As I said before, it's really a moving average, so the red %D in the middle panel has a span of 5, hence the second number 5 in the legend. Being a relatively short span, it hugs the %K quite closely. That's not the case in the bottom panel, where a 100-day span for %D is very smooth and not much help in generating signals. Please note that I'm not recommending any of these parameters. I'm merely showing short and long-term extremes so you can understand better how they work. There's also another parameter, and that's called the slowing factor. That slowing factor is merely another moving average that slows or smooths the %K and therefore the %D. In this chart, the center panel consists of a 5-5 stochastic with no slowing factor. The bottom one uses a 5 slowing factor, hence the extra 5 in the 5-5-5 legend. When comparing the two series, you can certainly see that the non-slowed version is much more volatile in its path. The addition of the slowing factor gives us a whole range of parameters to play around with. If you're a trader who thrives on overbought oversold levels, then you'd use short-term parameters. On the other hand, if you like the idea of simple crossovers from a smooth oscillator, then the slowed stochastic with a longer-term parameter would fit the bill. I'm going to go into greater detail concerning these possibilities later, but first I'd like to explain some of the popular ways in which the stochastic has traditionally been interpreted. For my money, though, the indicator does best with longer-term parameters which return a deliberate smoothing effect. Day traders looking for short-term volatility would probably disagree with me. Before we get to specific methods of interpreting the stochastic, please remember that any of the approaches that we previously looked at apply. These will be divergences, overbought, oversold, trendline breaks, and so forth. The next ones just happen to be applicable specifically to the stochastic. An important indication of a possible change to a bearish trend arises when a %K, having moved above the overbought zone, crosses below %D, moves back to test its extreme level, but fails to cross the %D line, as in this example. This is then called a bearish failure. A bullish failure forms when the %K, after a decline that takes it below the oversold zone, crosses above %D and then falls again, but does not recross below %D. It's always nice to see some actionable confirmation, and here it is. It may have been a bit late, but confirmation nonetheless it was. We see an example in this 30-minute chart of Microsoft, where the second rally attempt fails to cross both the overbought zone and a %D. This was later confirmed by the price. Note that on the bar of the trendline violation, the trading range of that bar exceeds that of its predecessor by a wide margin. This is known as an outside bar, and it's quite bearish. Later on, we see a small bullish divergence. I say small because the test of the stochastic low was pretty anemic, and it failed to generate a confirmation. Later on, a divergence failure formed part of a head and shoulders top, and this was confirmed for a very nice overall signal. In the case of an advancing market, a warning occurs when a %K line has been advancing for a while, and then, on one period, reverses sharply. For a daily stochastic, this will be a day, for an hourly, an hour, and so forth. This offers a signal that at best only one or two rising periods are left prior to a reversal in the price. The opposite would be true in a down market, where a warning would be a bullish factor. Obviously, warnings are unlikely to develop with stochastics whose parameters return a very smooth series, but solely with those using extremely short ones. This chart of Procter & Gamble features a 5-1-4 stochastic on an hourly basis. Note the 1 in the middle, and that signifies a slowing factor of 1, which means of course there is no slowing factor. We start off with a bearish warning. In this case, the next hour is when the decline begins. There are two other warnings of a negative nature. Here's a bullish warning, followed by a rally. Here's another one. Finally, we see a hinge on June 22nd. Following the start of the hinge, prices slow their upward ascent, and after about 3 or 4 hours, begin their descent. With a regular divergence, it's the norm to compare the rally peaks of the price against the oscillator. If the oscillator disagrees, then it's a divergence. The reverse is true for a positive divergence, where the oscillator makes higher lows, but not the price. Always nice to see confirmations, of course. A reverse divergence, also known as a bull and bear setup, or advanced breakdown and advanced breakout, compares the action of the lows. In this situation, the price is registering higher lows, and so is the stochastic. The price makes an even higher low, but the stochastic does not. Under these circumstances, we should expect to see one more rally, and then, if a confirmation is seen, a reversal in trend. The opposite would be true in a down market, where the price would make a series of lower highs, as with the stochastic. Then the stochastic makes a higher high. After this, expect one more decline, and then an advance, provided, of course, we get a confirmation. Occasionally the %K value reaches the extreme of 100 or 0, but usually only when the parameters are very short, like this 335 chart of Pfizer. If a successful test of this extreme occurs following a pullback, as it does here, this usually represents a timely entry point, but only when confirmed by the price, like this. When either the %K line or the %D line experiences a slowdown in velocity, indicated by a flattening line, the indication is usually that a reversal will take place in the next period. Here's a bullish hinge, and this thick red line represents a bearish one. This 10-minute chart of Pfizer shows one of each. See the slowdown in upside momentum here, and the decline that starts 2 bars later. Then a bullish hinge, but the price does reverse, but not before a nasty decline. So the reversal didn't take place 2 periods after the bar, but 2 periods after some losses. A stark reminder of why all these momentum signals need to be confirmed by price prior to taking action in the market. Now I'll have a bit more fun by trying to tweak the parameters to obtain a slower moving indicator where the %K and the %D crossovers can be used to good effect. This chart shows a 20-20-20 and a 20-10-10 combination. Both show divergences, but here is one for the smoother series, which subsequently is confirmed with this trendline break. The smoother series experiences just one whipsaw, whereas the 20-10-10 variety experiences 3. The trade-off is that the less smooth series triggers crossovers earlier, as we see here. However, if I position these arrows at the triggering point on the price, speed does not necessarily result in a better price, though usually it will. In this case, though, both signals developed around the same level. I like using stochastics with weekly data because of the smooth characteristics of the turns with some of the longer parameters. This one is a 40-20-20, and you can see the slow, deliberate path that it follows. In this chart there are no whipsaw crossovers, though I would say that's the exception rather than the rule. The key is to use these signals in conjunction with price action. Here, for example, we see a sell signal, and the arrow is pointing to the right because that's where the transports broke down from a head and shoulders pattern. Here's a bullish signal, which was later confirmed by an inverse head and shoulders. Finally, another sell signal, which was eventually confirmed by a trendline violation in the late summer of 2011. That happened at around the same time that the stochastic crossed below its overbought zone. Finally, we move up to the monthly charts. This 24-15-10 combination really comes into its own here. This combination in most cases will reflect primary trend swings in a fairly good way. Here's a positive stochastic crossover at the end of the 2000-2002 bear market, confirmed with a nice trendline violation. Here's another buy signal, again confirmed. Finally, a sell signal in late 2007 that was confirmed pretty well simultaneously with this trendline penetration. Summary for stochastics. 1. The stochastic indicator assumes that prices close near the low at the end of a rally and near their highs at the end of a downtrend. 2. The stochastic indicator is confined between 0 and 100 and consists of 2 lines, the %K and the %D. And 3. The stochastics lend themselves to crossovers, divergences, hinges, extremes, and reverse divergences, and are usually plotted in a slowed version. Well, that about wraps it up for this introduction to technical analysis. I do hope you enjoyed watching it as much as I enjoyed putting it all together. Just remember, you may watch this course a few times and know the basic points backwards, but for further study, you might want to visit pring.com, where we take a more in-depth look at technical analysis. Remember, you'll only be successful if you carefully measure your risk and know where you're going to get out before you commit money to the markets. Be patient, because there's always another train leaving. Be disciplined because you want all those ducks to be in line. And above all, never ever be greedy. Bearing that in mind, good luck and good charting.